Welcome to the Credit Clubhouse podcast, a deep dive into the world of credit markets and alternative finance. Before jumping into our next episode, we have an exclusive offer for our listeners. Just head to dealcatalyst.io, pick any event, and then enter the promo code CREDIT at checkout. This will provide you 10% off any ticket to any conference. This offer is limited to the first 50 ticket buyers. Don't forget, we want you to follow the show, rate us, and leave a review. We encourage your feedback, and we want to hear from you, the listener. The next episode is presented by 9fin. Every day, you're making decisions that matter. Which credit to buy, which deal to pitch, which covenant terms will hold. You need the right intelligence, you need it fast, and you need to trust it. That's where 9fin comes in. One AI-powered platform with complete visibility across public, private, and distressed credit, built for how credit teams actually work. Head to www.9fin.com/demo to request a 30-minute personalized demonstration. Again, that is www.9fin.com/demo. And now, on to our next episode. Welcome back to the latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Today is a bit of a special episode. We're doing a few of these. We're at the U.S. Private Credit Direct Lending Conference in Nashville. It's hosted by Deal Catalyst and the LSTA. And so we'll be doing a few episodes, kind of a special version of the podcast, but the first one of these is with Tom Quinn at 9fin, and Tom is one of their private credit reporters. Tom, thank you for coming on the show. Really appreciate it. Looking forward to our conversation.
Thank you. It's great to be here.
So obviously I mentioned that we're in Nashville. We're at 1,500 or so senior direct lending folks are here. You know, kind of what is the status of private credit market? I mean, what would you say, where are we today, considering we're at this event? There's been a lot in the news. Kind of maybe start with a bit of a level set of where we are.
Definitely. I mean, it's been quite a time to be a private credit reporter in this market. And we're coming out of sort of the end of this first quarter where we saw just tons of redemption requests from the retail investors and the BDCs. And that, has been sparked by a lot of different things that we'll get into kind of as we go on the podcast. But kind of watching this bifurcation of investor types and how they're responding to all of the news over the past year has been a really interesting period. And it points to where we are now, where with private credit, there's, what investors are doing, either increasing or trying to pull out, but then there's also kind of what's going on with underlying credit quality in these portfolios, and seeing how they interact with each other has been what everyone's talking about here.
And I know it's been defined as like a private credit crisis, but given that private credit is now more than just your senior secured direct lending, it's ABF is under that umbrella, fund finance is under that umbrella. I mean, it feels like it should be more of a direct lending crisis than a private credit crisis, but do you see it that way? Is it just focused on the direct lending space?
We absolutely see it that way.
Yeah.
So the bifurcation of investor types, I don't know that that's actually totally defined to direct lending.
I don't think it is.
Right? So KKR's ABF interval fund just gated their redemptions. So, and that would be different considered than direct lending. So there's obviously there's levels to each one of these parts, but to understand kind of how investors are responding to this moment in private credit, it might be more similar across investor types, but that doesn't mean that underlying credit quality is the same type of problem in each of the different verticals as well.
And speaking of ABF and maybe even some of the other sub-strategies, I mean, are you starting to hear, are people moving money from direct lending into ABF, into fund finance, into other things that might ultimately maybe benefit from the current crisis, that they're now moving capital to other sub-strategies?
Absolutely. So, the amount of private credit fundraising is continuing to grow, but we're not necessarily seeing it the same as growing in direct lending. You're seeing it grow across opportunistic, like you said, ABF, and there's also a huge secondary strategy that is growing as well. And I'm not sure that we're seeing a lot of those credits totally trade yet, but JP Morgan has just launched an interval fund as well. One of the, it's a public-private credit interval fund, and one of its focuses is on credit secondaries, where they have said, we believe there is an opportunity in this market, in the private credit secondaries market, to grow as well. So there's it's growing outside of just direct lending, where most of the stress seems to be right now.
So I know I referenced at the top, you're obviously one of the private credit reporters at 9fin. Tell us just a little bit more about yourself. How'd you get to 9fin? What'd you do before that? Just give the audience maybe a little more context around you and exactly what you cover at 9fin.
Exactly. So I'm a private credit reporter at 9fin, which is a debt specialist publication. We cover all sorts of credit, from investment grade, private credit, distressed, to your regular way leveraged loans. And so our reporters kind of specialize in one area in private credit, but we cover kind of the whole span of it. So that looks at M&A news. It looks at, I write mostly about legal docs changes in leverage finance. So that's sort of where we sit in this news ecosystem of credit. And then how I got here, I wanted to be a journalist. I graduated into a journalism field that was kind of tough to find a job. So
Changed
I went over,
a lot.
Yeah. So I had this, maybe I should be a lawyer. So I went. I'm not a lawyer, but I worked for Davis Polk, did a ton of different stuff for them for a little bit. Found my way back to journalism, and now kind of focused on finance and at 9fin, that space.
So obviously redemption requests have been all the rage around private credit and more specifically direct lending. You mentioned obviously the KKR ABF fund. Is it a lack of education around retail investors that maybe they were promised liquidity or promised the ability to get liquidity, and it's just, hey, maybe we didn't fully understand this product and we're trying to take our money out? Is it really about the underlying credits and real worry there? I mean, what is maybe some of the more finer look at the redemption requests themselves, and why are investors getting spooked a bit?
Yeah, so there were some really high profile credit blowups last year. Obviously, talking about First Brands, talking about Tricolor. And those have created a narrative about underwriting standards in leveraged finance. And I think there's a pretty robust argument to say that should not have been applied in the same way to direct lending as it has to other types of lending. And that's kind of what we have seen as one of the impetuses for this idea of trying to pull your money out as a retail investor from the non-traded BDCs. It's also a moment where if you're a retail investor and you're in this, in the past when you've tried to pull your money out, you've gotten it back, right? So the idea that you say, oh, maybe I don't like this and I'm going to try and pull my money out, and you don't get it back, it's definitely a point of education in the system. I think there's kind of a good open question is how much people knew when they were investing in these products. But one of the things that I think has been now very clearly communicated to the market and to potential investors in the market is that these are semi-liquid funds. They're not liquid funds. So
you're not getting all your money back.
Exactly, and semi seems to be an interesting way of describing that because you get 5%, right? They gate it at 5%. So it does feel like a point of education in the market. It does feel like a point of saying, okay, this is how we're going to move forward. In the past, we've honored your redemption requests. In the future, we're going to maintain this 5% gate because we have to. These are illiquid loans that we need. We can't just sell off at whatever price they might be.
So institutional investors, though, have stayed pretty steady with the asset class. I haven't heard the same things around institutional investors yanking their money. It's been primarily retail, and they obviously believe in the asset class, the institutional investor, that is.
We have the same opinion from the sources that we've talked to. So the best example of this is Goldman Sachs non-traded BDC, which had like literally just under the 5%, so they didn't have to gate their fund.
Yeah.
And in their letter to their investors, they claim like, hey, we have a high institutional investor base. We have people with strong conviction in this product, and so there does seem to be this argument from the institutional investors of, hey, this is still a strong product. We're not seeing those underlying credit quality issues that might be seen at the retail investor, and it also makes sense. They have different approaches to risk, to credit, to needing liquidity, right? So it's not. It all does kind of make sense when you really look at what the different needs are for these different investor bases.
I mean, is private credit a retail product?
I think the market is kind of learning what it means to be a liquid retail product.
That's true.
I don't know that that we can have the total answer for you there, but
I mean, it's an evolving answer, really.
Exactly. If you're comfortable putting your money into a fund that's going to be locked up, and you understand that there's going to be a 5% gate, and you can understand what's in these funds and all that stuff, then sure, it seems like that is what has been happening. But yeah, if you're expecting 10% returns and an ability to pull your money whenever you want, it's probably not the right fund for you.
So there is some underlying stress in the market. Obviously, tech has been one of those. Are there other areas in the market where either underwriting standards have maybe waived a bit, or there is heightened stress on that particular piece of the market? Is it concentrated solely in tech? Maybe talk a little bit about some of the underlying loans and where do you see stress in the market today?
Right. So when we talk about stress in the market today, I think it's important to talk about tech as the sector, and then it's also important to talk about kind of what's going on across the board in underwriting standards over the past few years. And as the amount of dry powder has just increased, the managers' need to deploy capital, you've seen a compression of spreads. So the lowering of the yields that you would get, you're seeing a kind of reduction in the standards of the docs themselves. So there's leverage constraints, all sorts of real doc loosening that's occurred, and then you have kind of what you've said about tech. And so one of the things that a lot of the sources I've talked to have said is we don't really understand what the tech issue is yet, right? So there's a concern that these models that are being created by AI are going to make software not as important and not as strong of a product as it used to be, because now you can code it with AI in seconds. But that doesn't just mean that software is the only thing that will be affected by that, right? So
of course
there's like clinical research organizations, there's different companies that, if you think about like, how can I make this a more efficient company in the future using AI to automate a lot of the processes, that's something that people are looking at as well. So when we say tech, it's like, how can AI approach this sector or approach this company and do it more efficiently? And that's the question I think that a lot of the investors, a lot of the managers that we're talking to are really thinking about when they think about stress in the portfolio.
And we really haven't felt the true impact on loans from AI yet. I mean, a lot of it's been speculation about what AI will do or what it'll impact. But one thing I do want to follow up on was, you mentioned obviously the loosening of docs. Is that because the pressure to deploy capital? Is it because new investors have come in, maybe pushed their way into deals and said, hey, we're willing to be a bit more flexible on docs or covenants, and here's money? Or is there another reason? I'm not, like, what is maybe some of the reason? Is it primarily so much dry powder and they just need to push it out?
Yeah, so we've heard competition.
Okay.
That's the main answer that we get when we ask this question.
Is that from newer managers, or is it more from some of the more established names as well?
I think it's across the board, right?
Okay.
Like there's a lot of dry powder that all these funds need to deploy, and they have to you deploy capital so that you can call it from your LPs, and that means that you get the management fees on top. So there's incentives from a manager perspective to make sure you're deploying capital. Also, if you're an LP and you've locked up your money into this fund, you're expecting the return, so they have to use it. So there's that competition in the market from newer managers, from existing managers, has made it such that, if you're a sponsor and you have a decent business and you go out to market and you say, okay, here's who wants to finance this deal, you can go and you can say, well, they're going to give me a better doc. So this is kind of the game that we're playing, and that's how you see the erosion of some of the protections in those docs as well.
So you mentioned obviously First Brands, Tricolor, recently MFS. Have you started to see a reaction from the market while talking to people in the market that, hey, we're going to tighten up our standards around verification or fraud checks or even docs and other things? Like, you have this kind of interesting thing happening in the market. You have all this dry powder that needs to be deployed and competition, but then you also have these fraud cases. And I'm curious kind of how the two are kind of playing against one another in some ways, because if docs and standards and covenants are loosening a little bit, but then you also have the fraud issue, or is it mainly just more of a verification change that firms are starting to make?
Yeah, so I actually think there's kind of two issues here. So the first is that, as we talked about, there's a gating of funds. There's a lot of pulling out from retail investors in the market. And what managers have actually said is that has reduced the pressure to get these docs done. There's also been less M&A as the software concerns have hit the market. So that kind of combination has actually, it's kind of grown the spreads a little bit. It's tightened the docs a little bit. It seems to be a little bit of a moment of normalization back to, if we were having this conversation at the end of 2025 saying the docs keep getting worse, the spreads keep getting lower, right? Yeah. Now I think we're having kind of, I wouldn't say the opposite conversation, but definitely more of a normalization question. And then, the second question is about the fraud cases and how people have responded to them. It's so interesting to see two cases that primarily did not affect the direct lending market and see how direct lenders respond, right? So, that happened to you. I got to protect myself, right? And so
it wasn't primarily a direct lending transaction at First Brands or Tricolor, right?
No, right.
But yet, obviously, the cascading impact has been hit direct lenders in a bigger way than I think other areas of the market.
Yeah, I think that certainly the perception, I think, has been that it's hit direct lenders. I'm not sure if you really look at the institutional capital flows in direct lending, how it's hit them. But from a retail perspective, from a perception perspective, I agree with you. But there's some good lessons to learn coming out of those two cases. And so to answer your question, we've noticed kind of two areas that people have changed. The first is in hiring private investigators. So this is something that private equity has done for a long time. It's also something that private credit has done for a long time, and direct lenders have done for a long time, but especially to non-sponsored businesses. Just making sure that you understand who you're going into business with. And the private investigators that focus on this space that we've talked to have said that their work has gone up, specifically from requests from credit. And then the second is the tightening of docs. So one of the areas that people are focused on after First Brands is securitization and accounts receivable factoring. And some of this non-recourse ways of growing capital have been capped in the private credit deals that have hit the market. And so that looks like a tightening of what a legitimate borrower, and I think that's an important point, what a legitimate borrower can do, right? That was not the case.
Certainly not.
So as that gets tighter, and as you kind of say, okay, no, you can't have this unlimited basket in certain cases, then that was a direct, we've been told is that it's a direct response to what happened in First Brands, and it's saying this isn't to stop fraud, but this is, hey, this happened, these cases happened, now we're focused on that area of the docs, and we're noticing that there's an opening there, and we want to tighten it. So there are definitely cases of how direct lenders have responded to tighten docs.
So there's been a push by a few firms in the market to now create benchmarks, increase transparency across the private credit landscape, but as that happens, private markets start to look more like public markets. Are we kind of on a path to private and public starting to look too similar, and maybe the erosion of that private premium, which people obviously pay for and get, but kind of where are we on the data transparency, what private markets are starting to look like today versus maybe 3-4 years ago? Because there's clearly a push to increase transparency across the market, across managers, to see how performance is doing beyond just maybe that fund that you might be invested in.
Totally. We've been seeing it as well on both, as you're saying, with the benchmarks perspective, but also the fund saying we want to increase the amount of times that we do marks, and all sorts of ways to try and validate the marks that they have in their portfolios. Obviously, one of the biggest sells of private credit is the illiquidity premium.
Yep.
So as you start to be able to trade in and out very easily, then you're going to lose that spread. But that doesn't mean that private credit's moving in that direction. So one of the things that we've been reporting on is people trying to make markets with private credit loans. And that goes from trying to sell, trying to buy, and the bid ask right now, at least from the sources that we've talked to, has said that it's pretty significant gap between the bid ask of these loans. So although yes, there's a huge push to kind of build more liquidity into this. We talked about JPM's secondaries strategy. Yeah. So that is happening, but what we haven't seen is real gung-ho execution of those trades. So the question, obviously, that no one can answer right now is, will we get to a point where those trades are really able to happen, or is this part of private credit, which is these aren't supposed to be tradable loans, and
there's no real secondary market yet.
Right.
So while people are trading in and out, they're really trading out and not really trading the loan itself.
Yeah.
So for it to really change, I mean, you do need a secondary market for the loans themselves to be traded.
Right. There's a bit of a secondaries market in the idea of trying to get off. Blue Owl obviously did a big secondaries trade. New Mountain did a big secondaries trade. So Apollo did a big secondaries trade. So there are secondaries trades, but those are large fund trades that have happened so far. And I agree with you, right? That individual loan perspective, which is where you would get that premium, would go away. Yeah. That part we're watching, it does happen as part of kind of portfolio calibration, but we're not at a point where we would say that this is turning into a lev loan kind of environment.
What's being overlooked in private credit today? Is there anything being overlooked in private credit?
So it's an interesting question. I think the tech question is important, and to understand that, whenever we walk into these meetings with sources, they always say to us, tech is just so broad of a term. So understanding exactly how it affects each of these areas, that's a really important.
Is the question today too concentrated on software? Because it feels like everyone's talking about SaaS and software businesses, but I mean, there's almost an endless amount of ways AI and generative AI can impact regular businesses as well. I mean, you can clearly become more efficient, cut 3 members of your staff, put them on the unemployment line, do that across thousands of businesses, and all of a sudden the economic conditions change pretty drastically. So are we looking at tech too focused on the software as a service and software businesses and not broader markets?
Right. I think that what's really interesting about tech is the idea that it's almost an uncertainty play, right? So we don't actually know how it's going to affect a lot of these businesses that we're talking about. The New York Times had a podcast on Monday where they talked about how AI can help small industrials companies, right, that have never been able to hire someone to do their kind of accounting or marketing or whatever, and AI can build a software to do that. So that would be a really interesting way that it benefits certain companies that we wouldn't expect. But it also could hurt other companies in that same space. So, and
we always talk about it in the sense of how it will negatively affect businesses, but it's also going to positively affect many businesses, probably equally as many.
Right.
We just don't, ultimately we don't know.
Right.
which is probably annoying investors.
Yeah. But that's, you're not seeing a lot of trades.
Yeah.
So I think that's part of it, is to say we don't, from an equity, part of the conversation that we have with private credit, and to be clear about direct lending,
Yeah.
It's married to the question of private equity. And you can't really totally take those away from each other because they're so intertwined in all of these deals. And so from an equity perspective, like, how are you going to have conviction in these businesses, these tech businesses, and how are you going to trade and decide that you want to support the multiple right now when you're not entirely sure what's going to happen? I think that's kind of another overlooked area.
Yeah, I mean, I think Bloomberg had something this morning about, you think the crisis is in private credit, but have you looked at private equity?
Right.
So I think that certainly has been overlooked in the current crisis, that we're quote unquote living through.
Right, and then, the last piece there is to kind of look at how PIK is being used to kind of prop up some of these businesses, and so there could be hidden distress that we can't claim is distress because we can't actually see the financials of the underlying businesses. But when you really look at the loans, you see that PIK was being added, or maybe a second lien was put in. So there's definitely some areas that we would look at, especially as private equity holds on to these assets for longer than they were expected to.
So one final question before we get to some of the fun questions and wrap up. If we're looking, obviously 3-4 years in the future, are we looking at a drastically different private credit landscape? Bunch of M&A, some firms haven't survived, some have obviously been scooped up. Or are we looking at kind of this is a blip on the radar and things are kind of still scaling and going at a pretty breakneck pace?
Okay, so as a journalist, you're asking my favorite question to ask my sources, and
now I'm putting you on the other side.
Exactly, and so I've actually asked this question kind of a lot over the last year, and over the summer, the answer was, nah, M&A is going to be back. We're breaking the dam, right? And then over the December, it was, no. In the new year, M&A is back. We're going to break the dam. Like, it's going to happen. And so, at some point, it does get to a point where you're like, I don't know that anyone has that ability to pull out the crystal ball and understand where it's headed. But there's definitely some areas that we think are interesting to look at. The first is secondaries in the next 3 years. If you can bridge that bid-ask spread and you can start trading secondaries loans in private credit, that would be a really interesting space for hedge funds and for more people to participate in potential distress in private credit. Obviously, no one knows what's going to happen with AI and which businesses are going to be affected. So that's something that we want to look at too. And then, looking at the rise of PIK in portfolios, is that kicking the can down the road? In some of these,
kind of come to a PIK apocalypse.
Right. I mean, some of the other problems with PIK is that it's recorded as income, but it's not cash. So it's just it's an interesting problem, to deal with when you really look at, like, from a portfolio management perspective, where they're going to be. So I'm sorry for my non-answer to your question, but those are the three areas that I think we would look at and we would try to understand, as this moves forward.
All right, so some fun questions, rapid fire as we wrap up here.
Okay.
Favorite sports team and/or hobby?
Okay, so sports team, I am from New Jersey, but I was raised by a Midwesterner. So I'm a Bears fan and a Knicks fan. So It's an interesting place to sit.
One surprising thing about yourself?
Okay, so I was trying to figure out how to answer this question. I was talking to my team before, and I was like, I've never had a brain freeze. And they were like, oh, so we're going to get slushies after. So I might have to, by the time this airs, it might be a different answer to that question. But I think I'm going to have to be forced to, like, chug slushies at, like, 7-Eleven across the street.
One book you'd recommend reading?
So I have to recommend my boss's book, which is Max Frumez and Sanjit and Dap wrote Caesar's Palace. It's an excellent book, Caesar's Palace Coup, talking about the bankruptcy. And then the fiction book that I would also recommend is, I just read Tomorrow by Gabrielle Zelvin. It's excellent. I have no interest in video games, never have, but this book was very well written, very interesting.
Well, fun fact about Max. is that we actually both worked for the same company way back in like 2005, 2006 called Deal Flow.
Uh-huh.
So I don't know if he'll remember,
Okay.
but we used to both work for that company. He was on the editorial side and I was on the event side.
Got it.
At the time. So
Yeah. So
little fun fact for you to take back to Max.
we both have had the pleasure of working with Max. So
Yep.
Yeah.
Most exciting part of your job?
It's being able to be on top of the market. Talking to people all the time and just really trying to understand and break through the noise of what's going on in private credit. I think what's so cool about 9fin is that we have the ability to really focus and really be specific here. And I think that just allows our domain knowledge to kind of be at a place where we have a good understanding of what's going on.
And then final question, one prediction for the next 12 months.
My prediction for the next, you're going to be reading a lot more 9fin. We just closed, yeah. So
Good way to end it.
Yeah.
Well, appreciate you coming on.
Thank you.
Thank you.
Yeah.
Looking forward to continuing to read 9fin, and appreciate the continued support. You guys are supporters of the show, so thank you, and good to see you here in Nashville.
Yeah, of course. Thank you very much.
Thank you.
Thank you for listening to the Credit Clubhouse podcast. The Credit Clubhouse is brought to you by Deal Catalyst, the leading capital markets events and market intelligence company. For more information on Deal Catalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.io. Thanks for listening. Until next time.